Good morning. Today is what is the date today? The 18th. Today is the 18th of July, Friday, 2014. Okay, Alpha Trading Strategies. We're looking here at three markets. We're looking here at Bank of America, equities, stock, of course, ES, the E-mini, crude oil, and GC for gold. Okay. For those of you that have just come to our site here at Alpha Trading Strategies, we utilize a methodology which triangulates the three pieces of data. I know, I say it all the time. It's true. It's vitally true because it's our edge, it's our golden goose. It triangulates the three pieces of data that is always present in market activity, and those three pieces are price, currently here with Bank of America, 1541, ES at 1965, crude oil 102.12, and and gold at 1307.30. Okay. These are three asset classes, three different asset classes. Um, Bank of America and the ES are the same asset class. Crude oil is a different asset class from gold, meaning that these two are typically going to rise in unison, um, and these typically will trade in their own realm. Okay, we've got positions in all four of these, and by utilizing isometry, essentially what we've done is we've created a leading indicator. If you notice here, there are no indicators on these charts. Zero. There are no moving averages, Bollinger Bands, stochastics, Keltner channels, Fibonacci retracements, SARs, uh, RSIs, MACD, none of that. Wow, we're really getting a lift right now in the ES. It was a very big day in the market yesterday. We're going to revisit some of the positions that we've had as well as additional positions we've put on. What is our advantage? Our advantage is that we're able to utilize this leading indicator because it gives us predictive value. But instead of trading the direct market, meaning instead of trading if Bank of America, the stock, instead of trading the ES futures, or instead of trading crude oil futures or gold futures, we will trade the options on all of these. Specifically, what we will do is we will establish what is known as credit spread positions. Now, these can either be bear call spreads or bull put spreads. Essentially, what the sequence does is it creates a environment in which the option we are selling is marked up with a decent amount of premium, okay, which we are selling um, to the moron masses. We call them the M&Ms. These are the masses of morons, or the moron masses that are in the market. What are the advantages of trading the options over either stock or futures? Well, let's go through them. The most important thing is the establishment of risk. You have a defined, predetermined risk amount. When you trade stock, essentially you can lose, um, you don't have your risk is kind of defined because the stock could go to zero. Okay, but usually you're going to be blown out by then. Okay, in ES, your risk is literally infinite unless you place a stop loss. In crude oil, same thing because these are futures contracts. In gold, same thing. So your risk in if you are trading stock or futures, your risk is not defined. I mean, you're going to have to define it yourself, and then there comes the where do I place my stop game? Do I place it here? Do I place it there? Too tight, I'll get tapped out, um, and then price could go in your direction. I place it too loose, then you know, do I do that, or do you use no stops at all? Okay, very hard to. It's going to be very hard to combine um, not knowing how to read a chart, because most traders don't know how to read a chart, in a environment where there is undefined risk. It's already become a recipe for disaster, but there's more. Number two is that these are bidirection. These are directional trades only, meaning you will only make money if price goes up, 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 up. Of course, that's assuming that you're long. Okay? The advantage with selling the option, it is what's called a non-directional environment, meaning that it can go up, obviously, and will make money. It can go up. It can also go sideways. It can even go down. As long as it stays within a certain range, anything above that or beyond that, we keep it. Time is on our side. Sideways movement in futures, nothing happens. Sideways movement in stocks, nothing happens. Sideways movement in the options, we still collect our premium. What else? We can establish the probability of the option expiring worthless. Obviously, there's no guarantee, but it gives us a pretty good indication of what's possible. So you're able to define your risk, you're able to actually define your profit ahead of time, as well as a probability of the option expiring worthless. And you can choose which option you want. For certain index options, you have a tax advantage. Now, we're not giving tax advice. This is what we understand. Section 1256. Certain index options are priced 60% at long-term capital gains, 40% at short-term capital gains, bringing the effective rate from 35 down to 23%. Very good. Um, and let's see. And the ability to establish your entry away from the actual price, which we'll get to in a moment. So let's go ahead and take a look at what's going on with our actual positions. Okay, SPX. If you look at our previous position, we were I think negative 225. We're at now 987. We sold some BAC puts, 14 and a half, 50. These will expire in 7 days, and we've locked in 150 of that. I think the total premium was about $750 or something of that sort. So we're doing fine there. And if you look at the chart here, you will see that we are rising nicely. Anything above 15, we keep. All right. Let's put that. Anything above 15, we keep. And you see it's rising strongly or decently. OAX. Basically, this follows the S&P. They all follow bar for bar. We sold yesterday, and that big sell-off yesterday, we sold the 850, 855 puts. 855 right now. This is what that is. This is the difference on the put that we bought to protect us and give us a defined risk. And so far, 1 day trade on that, we're up 42.50. And let's see, the 850, 855 put, we'll pull up that chart really quickly. So that means that anything above 855, we are a happy camper. Okay, right now we're at 876, and that big sell-off yesterday was about 10 points. So anything above all the way down here, we are golden. I don't know if that'll stay, but yeah. So it would take cataclysmic proportions before that to happen. Okay. SPX. We sold the 1950, 1945 puts yesterday. We sold a long time ago the 2000, 2005 calls. So anything below 2000 on the S&P, we're good. Anything above 1950 on the S&P, we're good. And crude oil right now is at 500. We sold the 104, 105 calls. Anything below 104.5, we're good. And gold right now is a no-brainer. We sold the 1260, 1255 puts. Anything above 1260, we are golden. Okay, so this is where we're at right now. Trading options. Options are beautiful because they're almost an esoteric vehicle. Really, they are we've discovered the promised land here because the advantages that are afforded in options, the time decay. You see, the thing about the weekly options is the time decay. So price could move, but because it's bleeding out time or there's no time remaining, it can't affect the option price. That's esoteric. The fact that options pricing is so non-linear, um, you get a spike down and they throw this option volatility premium that goes into the price, volatility. And as we've determined, volatility can move over different rates at different rates over time, which is standardized. But volatility, price movement can accelerate or different rates, and they mark that component into the price. And we right there, as we are identifying the reversal with our sequence, we are able to sell that premium. And all price has to do is just go sideways. And the first thing they lop off is the volatility premium. hmm I remember years ago when I was trading, geez, 1997 OEX options. I really feel like the return of the king here. Trading OEX options and didn't know what I was doing. I was trading about maybe 300,000 in options. And it was beautiful. I mean, I was all set up and, 5 monitors. And hold on a second. Yeah, just let him know that he can reschedule the class. Um, uh, yeah, I was all set up with the options, OEX options. Didn't know what I was doing. 4 beautiful monitors. Um, it's just state of the art video card and all that. Bought some OEX options. I think I bought them at 21. Didn't know what I was doing. In hindsight, options went from 21 to $7. And really, the thing that shocked me was that the market really didn't correct that much. And so I called down to my broker and I asked him. I says, "What the hell is going on with the options?" And he looks at it and he says, "Let me have your account." I gave him the account, and I didn't buy 300,000. I think I bought about 100,000 at the time of the 300,000. And he said, he looks, he goes, I'll never forget his words. He said, "Oh yeah, yeah." He said, "Do you don't really?" He said, "Do you know anything about volatility premium?" And I go, What's that?" He goes, "Yeah." He says, the thing about the options is that, they get marked up really explosively, and, the first thing they lop off is the volatility premium." And he said, he says, "Why don't you read a book called Options Pricing by Natenberg?" And I went out and bought the book. The book's about 6 inches thick. And it changed me forever. And so now, as a seller of volatility premium, we put ourselves in the bird's eye position. All right, guys, that's going to do it for today. Let's get a timestamp. The present time is 8:50. Okay, that's going to do it. If you'd like to know more, of course, you can go to our site, alphatstrategies.com. Take care.